Every financial advisor, every Reddit thread, every personal finance book written in the last 20 years has told you the same thing. Buy index funds, low fees, instant diversification, just set it and forget it. And for most people, that advice has worked out pretty well. But here's what nobody in that conversation ever bothered to mention. The same mechanism that made index funds the safest, smartest, most boring investment on the planet is quietly turning them into the largest concentration of systemic risk in financial history. And the reason you haven't heard about it is because it sounds too boring to be dangerous. It sounds like a spreadsheet problem. And spreadsheet problems don't get clicks. To understand why this matters, you need to understand what actually happens when you buy an index fund. When you put $500 into an S&P 500 index fund, you're not picking stocks. You're buying a slice of every company in the index, weighted by size. The bigger the company, the more of your money goes to it. And that sounds totally reasonable, until you look at the numbers. Right now, the top 10 companies in the S&P 500 make up roughly 35% of the entire index. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and 6 companies. Over a third of the index. So when your financial advisor tells you that you're diversified across 500 companies, what they're actually telling you is that 35 cents of every dollar you put in goes to 6 tech companies. That's not diversification. That's a tech fund with extra steps. And here's where it gets interesting, because this concentration didn't happen by accident. Index funds are market cap weighted, which means the more a company's stock goes up, the more money passive funds are forced to pour into it. And the more money passive funds pour into it, the more the stock goes up. It's a loop. And it's been running for 15 years. Think about it like this. Imagine you're running a popularity contest where the rule is the more votes someone gets, the more votes they automatically receive next round. Eventually you end up with a winner, not because they're the best candidate, but because the system is structurally wired to keep amplifying whoever was already winning. That's the S&P 500 right now. And the money flowing into this loop is not small. In 1990, passive funds controlled maybe 5% of the US stock market. By 2010, that number had grown to around 20%. By 2024, passive funds controlled over 50% of the US equity market for the first time in history. Let that sit for a second. More than half of all money invested in American stocks is now on autopilot. It's not making decisions. It's not analyzing earnings. It's not asking whether a company is worth what the market is pricing it at. It's just buying, mechanically, relentlessly, whatever's already in the index. And what happens to a market when the majority of participants stop caring about price? This is the question that a small number of people in finance have been quietly losing sleep over, because markets are supposed to be price discovery mechanisms. They're supposed to answer the question, what is this company actually worth? And they do that through active buyers and sellers disagreeing. One person thinks a stock is overpriced and sells. Another thinks it's a bargain and buys. That disagreement is what keeps prices honest. But when 50% of the market is passive, when half the money doesn't care about the price, you lose that mechanism. You get prices that are less anchored to fundamentals and more anchored to flows. Not what a company is worth, but how much money is being poured into the index this month. Michael Burry, the guy who shorted the housing market before 2008 and had a movie made about him, called this out in 2019. He compared it directly to the CDO bubble that caused the financial crisis. The same problem, the same disconnect between the price of an asset and its underlying value, just packaged differently. But here's the part that doesn't make the headlines. Because on the way up, this loop is wonderful. Passive money flows in, prices go up, your 401k looks great, everyone's happy, nobody asks questions. The feedback loop is your friend. The problem is feedback loops work in both directions. When the market sells off, and markets always eventually sell off, passive funds don't make decisions either, and they don't look at a company and say, this is undervalued, we're holding. They just sell proportionally across the board, whatever their investors are redeeming. The biggest stocks get sold the most because the biggest stocks have the biggest weights. So the same mechanism that inflated the prices on the way up is the exact same mechanism that accelerates the crash on the way down. The loop doesn't just stop, it reverses. And the math on this gets uncomfortable quickly, because right now, Nvidia is trading at a price-to-earnings ratio that assumes the company will basically grow its earnings at a rate that historically almost no company has ever sustained. And yet, every single month, billions of dollars from 401ks, pension funds, and IRAs are being automatically funneled into Nvidia. Not because a portfolio manager decided Nvidia deserves that money, but because it's big enough to demand it. When over half the market is buying on autopilot, price stops being a signal. It becomes a function of inflows. And that is a very different market than the one passive investing was designed for. Now here's what the index fund industry will tell you when you raise this, and they're not entirely wrong. They'll say active fund managers have historically underperformed the index, which is true. They'll say the fees on active funds eat into returns. Also true. They'll say that passive investing democratized wealth building for ordinary people. Also genuinely true. All of that is correct. And none of it addresses the systemic risk question. Because the argument for passive investing was never this is risk-free. The argument was this beats most alternatives. And for an individual investor making a decision about their own portfolio, that's still probably sound advice. The problem isn't that any individual person is making a bad decision by buying index funds. The problem is what happens when everyone makes the same decision and at the same time using the same mechanism. What's rational for the individual can become irrational at scale. Economists call this a coordination problem. The rest of us just call it a bubble. And the really uncomfortable part of this story is who ends up holding the bag. Because the way a market cap weighted index fund works, you're automatically the largest buyer of whatever the market has decided is the most expensive thing. You don't get to say no. You don't get a vote. The same feature that makes passive investing convenient, the automatic set it and forget it mechanism, is the same feature that makes you a guaranteed buyer at whatever price the market is currently running. And when the top 10 companies are 35% of the index, trading at valuations that require decades of perfect execution to justify, the passive investor is not diversified. They're concentrated in the most expensive corner of the most expensive market in history. Now, does this mean you should sell your index funds tomorrow? No, probably not. Timing a market unwind is notoriously difficult, and most people who try to do it just miss the recovery. But what it does mean is that the story you were sold, that passive investing is the safe, boring, low-risk option, is only half the picture. Because passive investing is low risk in normal markets, with normal levels of passive participation, with normal price discovery happening in the background. We no longer have any of those things. And the finance industry's answer to this has basically been silence, because the passive investing boom has been enormously profitable for fund managers. Vanguard, BlackRock, and State Street now collectively manage over $20 trillion in assets. Those three companies, vote the shares of the majority of S&P 500 companies. They have more power over American corporate governance than any entities in the history of capitalism. And they got there by selling you the idea that nobody was making any decisions. The index fund was one of the greatest financial innovations of the 20th century. That's not up for debate. But at some point, a good idea becomes so popular that its popularity becomes the risk. And when over half the market is moving on autopilot, buying the biggest companies because they were already the biggest companies, with no human being asking whether the price makes sense, that's not a diversified market. That's a very large, very slow-moving, very confident crowd, all walking toward the same exit. And the exits in markets are always smaller than people remember. Hit subscribe if you want to keep hearing the stuff that traditional financial media won't touch, because the real risks are never the loud ones. They're the ones hiding behind a 5-star Morningstar rating and a 0.03% expense ratio.